Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
So LyondellBasell, if you don't know the company, ticker is LYB. It's basically a chemicals company. It's a $30 billion chemicals company. Think things like plastic. It is also doing a lot of shift into sustainability, retrofitting certain plants to make greener stuff. And this stuff is important because it's things we use every single day and the most mundane things, and it's difficult to really decarbonize those sectors. Joining us now is Tracey Campbell, Executive VP of Sustainability and Corporate Affairs, but she's held many positions within the company. Tracey, great to see you.
Thank you. It's a pleasure to be here, and who doesn't want to be in Midtown Manhattan on a day like today? So
I know.
Thank you.
That means it's nice out, right?
It is
gorgeous
great. Outside.
We'll take your word
Trust
for
me.
it.
Yeah.
So let's just start with the macro for a second, because for those viewers who don't know, LyondellBasell makes all the stuff we need: plastics, ethylene, all the things. Right. How's it going? Like, what's demand like right now?
You know, demand has been very steady, certainly in the Americas, and I think demand got a bit of a boost yesterday. The economy did as well, so we're excited about that. And while, yes, some of the global markets are substantially weak, China, for example, is an important market, but we're not as exposed there as others. And of course, Europe's a bit slow to recover as well. But no, we're really excited about the demand that we're seeing here in the Americas. And I've been in the industry for more than 35 years. I've lived through this cycle of low demand and strong demand, and we don't subscribe to this doom and gloom that you hear out there. So we're excited about the recovery that we're going to see, because as you said, Alix, we make the materials that people count on every single day, and that's fundamentally not changing.
How does a company like yours and any global petrochemical company, plastics company, how do they balance the business requirements, grow the business, invest, deliver profits for shareholders, and then make this transition to maybe a cleaner business? How do you guys balance that in general?
We see it as an and. When you think about the value play that we have for more sustainable products, whether they're more circular, perhaps they're low emission products, we believe that that's a value proposition for the company as itself. And we have a play there because we can bring these products to market at scale. We're not doing it for the greater good of society. While that's an added benefit, we're doing it because we believe it's accretive to earnings in the long run. So there are consumers and brand owners out there that are looking for those materials.
So in what sense does this happen? Is it like we're going to use greener feedstock to make stuff? Is it we're going to use alternative energy, renewable energy to run our plant? Or is it we're going to capture any sort of emissions and then deal with it? Like, what's the strategy?
There are multiple strategies there, and I think you hit on quite a few of them. If you think about our strategy as a company, we still believe that our core petrochemical business is here to stay. However, we can change the way we operate, the feedstocks we use, the type of, like you said, renewable energy and things like that, to lower the emissions that are being generated as we make these materials. You know, another core piece of our strategy is to really, again, leveraging our core business to fund a much less capital-intensive ecosystem for circular products, for things, waste materials being brought back into our system and using those as the feedstocks essentially for the products of the future. So really, there is renewable energy, there is low carbon emissions, there is technology out there for carbon capture and utilization. All of these are part of the transition, including hydrogen, for example, to bring either fossil-based materials or renewable and recyclable materials to the market. That we're looking at all of those.
I know. I mean, your company is truly a global company. Roughly half the revenue in the U.S., half your revenue outside the U.S.
That's roughly right.
How are the requirements or the environments for maybe migrating your company to a more eco-friendly business model? Is it different in the U.S. than it is outside the U.S.?
I think the pace of change is different in different parts of the world. But we see that change happening on a global scale. For example, in Europe earlier today, in fact in Germany, you'll see our press release soon, we are laying the foundation stone of our first scalable advanced recycling unit. And we see the Germans and the Europeans advancing quickly, right, with respect to embracing circular and low carbon. But we are seeing the same trends here in the United States and even with our joint ventures and our activity in Asia. So it's just happening at a different time scale. but the momentum and the energy and the excitement around those products is really not different. The policies might be a little bit different depending on what country we're operating in, but our direction is still the same. So we're very excited about that announcement today in Germany.
So talk to me about cost for a second. So the working theory is that when you make stuff green, it costs more. So A, is that even true? And if it is, how do you offset those costs? I mean, yeah, and how do you offset it? Like, do you wind up having, do the end user have to pay more? Or are there different ways it's offset, even if it's from policy, like tax credits?
Mm-hmm. You know, when technology it's new, and when you're transitioning technology, yes, there are investments that need to be made to accelerate that transition. So, you know, I don't think in the long run the materials will cost more. But the transition, of course, is where the investment is tricky, right? And we need to look at that. But if you look at consumer demand for these materials, if you look at the government's programs that are out there to accelerate the transition, the unit that I spoke about that we're laying the foundation stone in Germany just this morning was a recipient of a European Innovation Fund, you know, millions of dollars to help us with transition. But we really see the consumers stepping up, the brand owners stepping up, and I think over time the technology to make this transition, tax credits, for example, for hydrogen production, for hydrogen consumption are important as well. So I really see a lot of activity in that space to help us transition.
Jason from Omaha, Nebraska writes in, how have ocean freight costs affected the U.S. ability to export our cheaper plastics to the rest of the world?
Ocean, you know, I'm not an expert on ocean freights anymore.
Okay.
I used to be at one point in my career.
You can still play one on radio.
Yeah, I can still, pretend. But, you know, what we think about as our company, we really focus on differentiating our assets in terms of feedstock advantages, technology advantages, scale advantages. So do we have assets in regions that depend on ocean freight? Mm-hmm. Absolutely. We have JVs in the Middle East. We're growing there. We have owned assets in the United States. And yes, we do export these materials and we stay on top. And we actually have a supply chain organization that is constantly looking at the optimization of freight to make sure we can deliver those materials to market very competitively.
In terms of all of it, the transition, dealing with current slowdown in Europe and Asia, etc. And this comes from Orion Hornan. So, see, I'm going to ask your question. Do you think that animal spirits will awaken and we get more M&A in the chemical space with those low rates? And then I would add on, are you kind of forced to make acquisitions or even bolt-ons as you're also making this energy transition?
You know, growth is important to us, and I talked about growing and upgrading our core and even growing this circular and low-carbon economy that we're looking at. So I think M&A is always part of our optionality, right? You've seen us grow our footprint in the Middle East. I lived in Asia recently where we grew some footprints, we grew some joint ventures over there. So I think M&A is always going to be in the cards for us, and we do see ourselves as a consolidator and a very efficient, scalable provider of these circular and low-carbon solutions. So there's a lot of activity that we're doing there to consolidate feedstock acquisition, to build these integrated hubs in order to have a very scalable and optimized delivery system for these materials of the future. So M&A is always an option for companies of our size, for sure.
Again, as a global company, I'm guessing you guys have a vested interest in all this talk coming out of Washington to various degrees, various parties about tariffs and things like that. Does that impact your business? Has it impacted your business over the last 4 or 5 years? And
you know, tariffs to me are, I'm a believer in a free market economy.
Right.
And I think tariffs in the long run tend to hurt that. So, you know, we really are positioning our company to be resilient no matter the outcome of any election in the world. So, you know, we're making sure that we've got the right products, the right assets, we have that differentiation to really be successful, regardless of whether a particular person wants to have tariffs or not. So
that was a very that was an SVP answer. Like
I try to be an enterprise thinker.
It's fair. It's fair. When we talk about the cost situation, and this also plays into Paul's tariff question, do you secure customers for your products and that then help you build the product, or after it's done, do you have to go out and sell them? And what do both of those processes look like?
We work with brand owners and with customers to build the future materials and to help design those applications of the future.
So they have to commit to stuff. They have to be like, we will give you this much money for this much product.
We work with them right from the early stage of concepts through design, through perhaps a long-term contract, for example. But yeah, being a solutions provider requires us to really develop those materials together.
Is it hard to come up with those numbers right now with your customers in terms of pricing?
I don't think so. I think we've always worked with our customers and with downstream, so the entire value chain to really design the materials that, consumers like ourselves are looking for. So yes, as we work through that process, we're looking at our cost to deliver the material, the intermediate, the converter cost, the consumer cost, but I don't think the uncertainty is any more, is any higher than it's ever been, frankly. I think it's just something that we're always making sure that we design for all options and we have the flexibility to pivot if we need to.
All right, Tracey, so great. I've been trying to get Tracey on for since February, March of this year?
Yeah. It's great to be here.
Thank you so much. Really appreciate it. I know you're here for Climate Week, so I'm looking forward to what will come out next week as well.
Right.
Tracey Campbell joining us there. Your title's long. What is it's SVP of...
No.
I'm trying to find it.
I've got Executive VP of
have it.
Sustainability
There
and
it is.
Corporate Affairs.
Oh,
Yeah.
Click on that email, Alix. Come on. All right. Tracey, appreciate that. Joining us from
Thank you.
LyondellBasell on all things energy transition when it comes to petrochemicals.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Markets at a record. There's some serious volume coming into play. I was talking to one market technician who was like, we got options expiration tomorrow. You got to reshuffle your delta, which I guess is a fancy option word. So that's why you're seeing a lot of the flows here. Emily Roland is co-chief investment strategist for John Hancock Investment Management, and she joins us now. Emily, do I just blame technicals and options expiration, or is this some serious real FOMO here?
Yeah, no, I think that's probably some noise that does occur periodically. Look, markets are celebrating today. We're near new all-time highs, or kissing them, as you said earlier. And I think there's a lot of relief around this dovish pivot that the Fed has taken here. There was a bit of confusion in the markets yesterday after Powell came out and told us not to get too excited that more 50 basis point cuts aren't coming. But I think overall it was a dovish Fed meeting, and it looks like markets can continue sunning themselves on soft landing island.
Soft landing island.
Very nice.
Netflix season 1.
Exactly. Hey, Emily,
Right?
we've actually got a yield curve that's steepening here. We got the 2-year at 3.58%, the 10-year at 3.72%. What does that tell you?
Yeah, I mean, your bond yields came a long way prior to this dovish Fed meeting yesterday. So I think you're seeing a little bit of repricing there across the curve. I think that we could see some chop in rates from here as we kind of navigate through this environment where there's kind of some better than expected economic data. Maybe we're continuing to see some broad deceleration. But again, this deceleration is happening slowly enough that it's sort of providing this perfect backdrop for the Fed to continue to implement rate cuts amidst a decelerating economic environment. It's going to happen in choppy fashion. But for now, I think you're kind of going to see rates hold steady, as yesterday was the big event. We've gotten through it, and we'll see what happens from here.
So do you chase here, or is there something on your shopping list, or is it just a rotation at this point?
Yeah, I mean, we would look at any backup in bond yields as a nice opportunity to lean in. Income there is still elevated. Of course, yields have come down a lot over the course of the summer, but we still don't think that bonds have fully sniffed out this disinflationary, lower growth environment. So we like higher quality bonds, areas like mortgage-backed securities, investment-grade corporate bonds, sprinkle in a little bit of treasuries there. So we think there's a buying opportunity there. Stocks are fully reflective of this soft landing backdrop. We continue to embrace higher quality stocks. And we're looking for areas that provide quality at a reasonable price as well. So we would be leaning into things like healthcare stocks. We're legging into more defensive areas of the market like utilities and infrastructure equities. And we continue to see U.S. mid-cap stocks as a big beneficiary of onshoring activity and the fiscal spending that's still happening against this decent economic backdrop.
Emily, when you get big moves in the market like we're seeing today, that kind of just raises the valuation flag for a lot of investors. How are you kind of thinking about valuation in the equity markets?
Yeah, I mean, it's not great. I'll tell you, certainly with markets, bumping up on 21, 22 times forward earnings, I think they're well priced for the soft landing scenario that we've been talking about. And you look at areas like technology stocks, which are trading at 30 times forward earnings, which is about as high as we've gotten over the last cycle. It's not the 50 times forward earnings that we saw in the late 1990s. So I think the froth is a bit of a concern, but I would tell you that valuations just simply aren't a catalyst for a market rotation. They haven't been historically. I think you'd need to really see some kind of shift in the economic regime. You'd have to see a big shift in earnings trends to really see that market leadership change. And, you can blame a lot of things on the multiple expansion that we've seen in technology, but you can't blame the denominator. The earnings have been there for these companies, which makes us continue to be constructive there.
Which also then raises the question, where do you go in terms of large, mid, small? So I've been reading a lot about, particularly from Bank of America, how maybe this is the time for mid caps. And mid caps hit a record high yesterday. They outperformed yesterday. Is that the sweet spot for that environment that you're talking about?
Yeah, mid caps are the sweet spot for us. When you go down into small caps, you're looking at companies that are unprofitable. They have higher interest burdens. The Russell 2000 is comprised, about 40% of that index is comprised of companies that don't make money. They could do really well in an early cycle environment, but we just don't think that we're there yet. And you see these little rallies in small cap equities based on the idea that rates are coming down. But remember, rates are coming down because there's a challenge with growth. And we think that that does not benefit the most cyclical areas, namely small caps. Moving up into mid cap equities, you get a big overweight to the industrial sector. So think about the relative sector composition there. And we think mid-cap industrials are massive beneficiaries of the spending that's happening in the U.S. There's a manufacturing renaissance happening right now in the U.S. Midwest due to onshoring and due to things like the CHIPS Act and the Infrastructure and Jobs Act. So we want to look to mid-caps as a way to capture that. They're also trading at the deepest discount to their large cap counterparts since the late 1990s. So you're not overpaying for this theme.
Emily, how do you feel about the earnings backdrop here for the market?
Well, I love it going into the third quarter because the bar is low. It's actually, analysts are penciling in 4.3% earnings growth as we look forward to the next quarter's earnings season. So we love a low bar there. I think we should enjoy it while we can. Because Q4 earnings growth is penciled in to be about 15%, and then analysts are looking at 15% into next year. So not only is the market trading at an elevated valuation, but that's also against expectations that we're going to see about 15% earnings growth next year. That's probably a bit optimistic. So we may, see a challenge to that. Right now, multiple expansions helping as we continue to embrace the Fed pivot here and the soft landing. But ultimately, the earnings need to come through as stock prices over time are going to follow profits and follow earnings. So we think that's going to be critical to watch as we look forward.
Emily, great stuff. Really good to see you. Emily Roland, Co-Chief Investment Strategist for John Hancock Investment Management, joining us.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
It's a good moment to check in on media stuff and media deals. And I read that really interesting article in the Wall Street Journal about how there's going to be a show on Amazon where people get to basically compete to get a slot in their big Amazon.com store. So they're describing it as like Shark Tank meets Home Shopping Network, which, I don't know, for me,
you
this
would
is
actually
like
watch this.
100%. Would you not? Okay, you're not going to watch it, Paul? No, that's not his thing. Geetha, help me out. Geetha Ranganathan, Bloomberg Intelligence, U.S. media analyst. This sounds brilliant to me. Did you see this article?
I did not, but it definitely sounds intriguing.
So it's a new competition show next month. Entrepreneurs are going to pitch their products to a studio audience as well as to judges, including Amazon executives and some celebrities like Goop founder Gwyneth Paltrow and designer Christian Siriano. And then finalists will have their inventions sold in a new Amazon Buy It Now online store.
That's synergy.
That's what I'm saying. Yes, whether or
go.
not you watch it, that is some synergy. So she's not going to watch it. Am I the only one that going to watch it?
I think so.
All right, fine. Okay. All right, you talk now, Paul.
All right, Geetha, thanks so much for joining us here. What I want to talk to you about is just kind of where are we these days, Geetha, on cable networks staying on cable systems like the old days. I know Warner Brothers Discovery, they have a new deal with Charter. Talk to us about that and why it's important.
This was a really big deal for Warner Brothers Discovery. And the reason it's such a big deal is, of course, one thing is 90% of Warner Brothers Discovery's profits actually come from its television networks. But the reason it was so critical, and especially from a timing perspective, was because Warner Brothers has just lost its rights to NBA programming. And remember, NBA is one of the main draws for TNT, which is their most expensive channel right now in their network lineup. And so there's been a lot of fear, amongst investors that Warner Brothers TV revenue, especially its affiliate fee revenues, is going to be a tremendous risk. And so this deal actually with Charter, it was actually coming up for renewal only next year, but I guess David Zaslav wanted to go ahead and assuage investor fears. And so he signed this deal a whole year in advance, maintaining the same affiliate fee revenue trajectory. So it's definitely provides some temporary relief just from an outlook perspective for Warner Brothers.
All right, fine. See, but they're struggling because there's cool shows like this, like Shark Tank and Home Shopping Network on Amazon now. Whatever, fine. All right. So, what other questions are still bubbling up in the media community? There was a great piece on Bob Iger's succession a couple weeks ago, talking about that. What else are you focusing on?
So carriage continues to be a big, a big bone of contention across the whole TV space, Alix. I mean, yes, we had this Warner Brothers Discovery Charter deal, which was somewhat of a low drama deal, but there was one that was high drama, and that was actually Disney with DirecTV. Those two companies were fighting it out. There was a blackout of all Disney programming on DirecTV systems for almost 2 weeks until finally both of them caved. And Disney obviously wanted to have carriage-free increases, which I think it got. What DirecTV was really looking for was more flexibility in, programming and packaging, and they got that. So we're seeing kind of all these deals become really contentious as kind of the whole video landscape keeps shifting. So carriage continues to be a really big thing, and then the other thing is, of course, we have the M&A chatter coming up every now and then. The most recent one, of course, was DirecTV with Dish. That will obviously have huge implications for the entire TV landscape.
So let's switch gears a little bit to a business that I think is actually investors still like, and that's the theme park business. When we think theme parks, we think the Walt Disney Company, and I'll be down at Walt Disney World in a few weeks doing some due diligence. But Comcast also has a big theme park business. Talk to us about their theme park business and the investments they're making and how important it is to that company.
Oh, absolutely. So with Comcast, I mean, when we think of Comcast, we always think of the cable business, and rightly so. Cable actually makes up 80% of their EBITDA. But the one area that has kind of been ignored for Comcast, I think, over the past few years has been their NBC division. And NBC, through Universal, of course, not only owns TV networks, studios, but also the theme parks. And the big thing for Comcast and its theme parks is they're actually opening a whole new theme park next year, which is Epic Universe in Orlando. It actually doubles their entire Orlando footprint. So they go from about 800 acres right now in Orlando to almost 1,600 acres with this park. And it's going to obviously do, so much for their attendance. So right now, Universal attracts about 30 million subscribers domestically to their parks. Of course, the big behemoth is Disney with about 80 to 100 million almost domestically. But with this, we think Comcast actually kind of gets closer to Disney, right? They can get to about 40, 45 million visitors to their domestic parks on an annual basis. So it's going to do a whole lot for their attendance. And really, Paul, as we kind of see the business going out, we think, theme parks it used to be a few years ago, theme parks was about 25% of NBC's profit. In a few years, we think theme parks can actually be 50% of NBC's profit.
That's fascinating.
Well, it is and it's not. It's good because the theme park business is growing, but it also reflects the fact that their cable network business is declining dramatically, and that's the cash flow historically that investors have liked.
I mean, I guess I wonder though too is that also more recession-proof or not? Like, what goes first, ad spending for a linear TV or people not taking their kids to Disneyland? Is there an Avengers theme park? Do we know?
I don't know.
Why am I asking Paul? I don't know. All right, anyway. Thanks, Geetha. We appreciate you. Geetha Ranganathan, Bloomberg Intelligence U.S. media analyst.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, let's get to David Kudla now, a founder and CEO and Chief Investment Strategist, I should say, at Mainstay Capital Management. He joins us now. Hey, David, are you buying into this record rally here?
We're buying into this record rally. I know that there are many who are still concerned about a recession, that are worried that the price of stocks at these levels, we're at new highs. But look, what we've seen here now with this cut yesterday, and what we have going forward, if there's such a thing as a Goldilocks scenario, we're about as close as we can be to it. So, I've had the expression for the last 2 years, the recession that's always 6 months away. GDP right now, Atlanta GDP now for the third quarter is at 2.9%. We had 3% growth in the second quarter. We're still looking for that soft landing that the Fed rarely pulls off. So more of a mid-cycle slowdown, and then we slowly reaccelerate, and we don't get that recession. And if that's the case, 12 months later, after a first rate cut, stocks are higher and significantly higher. If you get a recession after a first rate cut, stocks are lower. So that's what we're pivoting on, but we're still optimistic and constructive on stocks at this point.
So, David, I think when I listen to some folks that are still constructive on the market, they just I think they hang their hat on a couple of things, which is one, I've got a Fed that's cutting rates, and I've got a pretty decent earnings environment. That's pretty good. But one of the things that we just don't know, it's an election year, and I don't know what that means for the markets. How do you guys talk about that to your clients?
Yeah, I'm glad you brought that up. We get preoccupied with politics as it relates to our investment strategy. And when I say that, I mean at average investors out there. There are investors that believe if so-and-so gets elected, it's doomsday. If so-and-so gets elected, it's nirvana. What we find out is, and this is why we'll have volatility over the next couple of months until the election, is the markets hate uncertainty. So it's about getting that uncertainty out of the way, but then it's not as much about whether it's Democrat or Republican. As far as where we invest, as tactical asset allocators, we want to look at the difference in policies. There's differences in policies in energy and a lot of areas between these two candidates, and depending on how the House and Senate go in terms of taxes and everything. So that matters as far as tactically how we invest. But the people that go to cash because they're scared, concerned, wait and see, end up typically in election years, end up suffering an opportunity cost. And that's exactly what's happened this year so far for people that have stepped to the sidelines.
Is there a risk, if I pivot back to the Fed for a second, so put elections on the side, is there a risk that we're going to see kind of more growth and demand resurface in a particular way because we're in that rate cutting cycle, because we got that jumbo rate hike? And is that a risk eventually for a resurgence in inflation?
It is a risk, but what we've seen so far is inflation is on this glide path to the Fed's target. If anything, I think with the disinflationary forces that'll come back into effect as we get by all the effects of the pandemic, we may overshoot the 2%, but we're certainly on a glide path to 2%. And right now, where we are with the labor market, we had some good news today. There's still some concern out there about credit card debt, credit card interest rate. loan delinquencies, things like that. But we balance that all out, and we think the inflation problem is gone. It's now about labor, unemployment. We get to the point where that needs to be. Rates come down to, if it's the long-term neutral rate of 3% here through 2025 for the Fed funds rate, we're in a good environment for stocks still. We know they're expensive, but stocks can be, we know, overvalued or undervalued for a very, very long time.
All right, David. So what sectors are screening well for you these days? Again, we've had an S&P 500 index move about 20% year to date, but I know not everybody has participated. So how are you guys approaching maybe like sector selection?
Right. So, one area for sure that's been troubled for quite a while, especially a while back here with some of a few of the bank failures, but banks, financial services look very good. As the yield curve continues to steepen, NIM improves, net interest margin for the banks. We're finally getting that yield curve steepening. So we like the financials a lot. We still like technology a lot, the AI story. But what we're able to do now, we can broaden into value. We can broaden into cyclicals. We can broaden into small caps and diversify our portfolios from the Magnificent Seven to these other areas. Small cap companies are far more reliant on debt, and with interest rates coming down, their cost of capital coming down, maybe coming down a lot over the next year. That's good for small caps, and that's what we've been seeing recently in IWM or the Russell 2000 index.
Mid caps, sweet spot. You like them?
Mid caps as well. Mid caps, the same thing. Small and mid caps just become more attractive. And mid caps are kind of that sweet spot in between. It's been a large cap dominated stock market for quite a while. We've had a lot of head fakes with small cap and mid cap, but we think they now have a runway with rates coming down.
All right, David, thank you so much for joining us. Always appreciate getting a few minutes of your time. David Kudla, he's the founder, he's the CEO, and he's the Chief Investment Strategist at Mainstay Capital Management. I call him the boss there, I guess, basically.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, the Fed cuts rates. One of the beneficiaries, I would think, would be real estate people. People, if you want to build a building, develop a building, if you want to rent in a building, buy in a building, I mean, it's got to be good for them, right? Money's cheaper. Let's talk to somebody who actually does it for a living. Miki Naftali, Chairman and CEO of the Naftali Group, joined by Abigail Doolittle, our markets reporter for Bloomberg News. We got them all here in our Bloomberg Interactive Broker studio. Let's talk luxury condos. I'm asking for a friend here, Miki. Talk to us about the luxury condo business. I know that's an area of the market that you know very well. You're very active. Just give us a sense of how the market is in New York City these days.
Right. So the market is actually good. We opened last week 3 sales offices at the same day, the same week, which is a record for us. And all 3.
So does that mean you have 3 new projects starting?
3 new projects. Okay. They're already under construction, but we launched sales. Upper West Side, Upper East Side, and Williamsburg on the waterfront. All 3 are doing very well. There is not much inventory in New York City, and buyers are looking for the right product.
So the Fed cut rates yesterday, of course, by 50 basis points. That certainly helps you, I imagine, with some of your carrying costs. But given the fact that you are catering to a higher net worth individual, how many cash deals do you see, or does this really help, your buyers as well? Right.
So it's very interesting. The more expensive apartments, we see cash type of deals. But when we do have, for example, in Williamsburg, we have a lot of the inventory trading between 2 to 5 million. Those are buyers that usually take mortgage, and the rate cut is obviously helping them a lot. And I suspect that we'll see much more activity in the market in the next 12 to 18 months.
What is the competition like to get the apartments? Like, is there the kind of competition that we would have seen, say, 5 years ago for these kind of properties?
Yeah, so there is not much inventory, and definitely there is not much of quality inventory. The reason is that it was and it's still very difficult to get construction loans. So for example, developers are just sitting on the sideline. They can't get construction loans. There are not too many projects under construction in New York. That's number one. Number two, construction cost, insurance cost are just really almost double than 5 years ago. So it's very difficult to get to a point that a project makes financial sense, which means that there is very low inventory.
So you're saying that there's very low inventory, and yet I've certainly been a part of the speculation, other people have been part of the speculation, that some of these massive buildings out here on Billionaires Row, or even some up on the Upper East Side, one of which I know for a fact a few years ago, a big bulk of it was empty, even though you never would have guessed that from the website. So has all that inventory that would seem to be floating out there in these fancy buildings, has that been eaten up?
No. So,
but you're doing well.
No. Yes, but it's all about quality. First of all, whatever someone decide to call this 57 billionaire row, this is a different market, really mainly relying on foreigners. How many New Yorkers really want to live on 57th Street? Think about schools, think about a kindergarten, whatever, right? You need the infrastructure. It doesn't feel as a residential neighborhood. Beautiful views, big buildings, right? So those are catered to foreigners. So we had the Russians, they're not buying anymore. We had the Chinese, they're not buying anymore. And so on and so forth. And every time there is a wave of foreigners that are coming to New York, because New York is still the capital. I see it as the capital of the world, right? But this is a very different market. It's also about quality. Yes, there are a couple of buildings that are not selling well, but when you dive into the detail and you walk those buildings and you look at those apartments, they're not good. They're not well designed. They're not well, aesthetically, they're not good. Whatever, maybe they're in a busy area. So it's all about the buyers are very sophisticated. Buyers know what they want. And when they see a product that is well designed, well located, and reasonable price to the market, to whatever the market, they're buying. There's not much inventory in this segment of the market.
That's really interesting to hear about a divergence within the high end there. I would not have necessarily anticipated that.
All right, so you call me up and you want a construction loan.
Right.
Why am I making a loan to you and maybe I'm not making them to other people?
You're right, and I have an answer on the two sides, because part of our business is debt business. We are lending to other developers. So we're running also a debt fund. And it's all about reputation, and it's all about, can this developer can really get the project done? And the commercial lenders are looking at you, if you ask for a loan, and they look at your reputation, what you have done. I mean, are you capable to do it? Do you have enough equity? And if your underwriting make financial sense. And if you are dreaming dreams and the project that you have in mind is not going to make financial sense, you're not going to get financing. Definitely not from the commercial lenders. You might be able to get financing at 10 over SOFR, right? Okay, you're not going to make it, right? So you really want to be in the mid 3s to low 4s over SOFR, and that's the only way you're going to make it.
Are there any deals you think to taking office buildings and converting them? I feel like this is a pretty sensitive topic. Like some are like, yeah, I can totally make money off of that, and others are like, no way.
Right. So there's a lot of hype about that, and from 2000 to 2007, I converted a lot of buildings in New York from office to residential. So I have a lot of experience doing so. Most of the office buildings, their floor plate, each and every floor is just too big, too deep. Residential, you have, for each and every bedroom, you have to have light and air. You have to have a window, you have to have legal light and air. There's a certain distance that it needs to be from the neighbor building. And when you have for example, here, this floor is very deep. So it's very good for office. It's very good for studios. It's not very easy to convert it to residential. So there's a lot of hype.
Yeah, really nice floor through the apartment, right? I mean, light from both sides.
Right. So when you are close to the window, right, that's great. Here is the problem. Now, when you try to convert it and you have a lot of space that is not usable, what are you going to do with it? So it goes back to, yes, you can convert those buildings, but most of those buildings need some type of incentive either tax or some type of incentive to help the developers to convert them. And if you really stop for a second and you ask yourself, how many of those buildings are really being converted versus all the talk around it, there are not too many that are doing well.
Speaking of office, in terms of the overall commercial real estate space, I know that you don't do office, but other developers have told us that the weakness from that one space, that there is an impact on the rest of commercial real estate. Do you feel that at all?
So I don't do it for a reason, because I think the residential space, to me, is the most safe kind of a space or sector in real estate. But what we see in the office space is very interesting. The brand new, truly Class A office buildings are doing well. Those that are new with all the amenities and the state-of-the-art systems, mechanical systems, those are doing well. But if we look at New York, and not only New York, every major urban city, there's a lot of inventory of what we call B and C type of office buildings. Those struggle a lot. Some of them will need to be converted from one use to another.
But does that weakness there in the possible defaults that could be coming, and just everybody's talking about, extended pretend values, does that impact your area at all? Do you see it pushing out in any way, like on the financing, that sort of?
Right. No, because the residential construction lenders are not, they mostly focus on the residential sector. The same as when we, on our debt side, we focus only on the residential sector. I don't know enough about the office or retail to really make a judgment if one location or one building is better than other. I have a general view, but it's so specific. Real estate is so specific, and it's quite sophisticated. I better know what I'm doing before I lend money to somebody.
So much money, yes.
Hey, Miki, before we let you go here, give us your thoughts on South Florida. I know you've got experience there as well. Are we overdone there, or is it still got strength?
So South Florida, let's zero in again, because every market is different. I think Miami is actually doing well. Of course, it's all about the very delicate between inventory and demand. But Miami matured to a point of no return. There's so many great things in. This is not only anymore just, I want to be there a couple months during the winter time. I mean, there are amazing restaurants, museums, sports. Whatever you want is there, not to exactly the level of New York City, but very close to it. So the market is doing well. We have a very big project in Miami. This is the 4th sales office that is open for us, and the product is selling well. So what we see over there, we see different buyers than we see in New York City.
And just real quickly, 30 seconds, who's your buyer? Who's your best buyer to walk through the door?
Where?
Yeah. It's not the Russians, it's not the Chinese.
Right.
Who's a good buyer for you?
Just someone that really wants to buy and really looking for a product in a specific area. And I want them to step in and look at my product. And if they like it, that's 50% of the sale, right? It might be too expensive for them. It might be whatever, not the right size for them. But if they step in and they like the product, it's 50% of the work.
All right, Miki, thank you so much for joining us. Really appreciate it. Love getting your perspective. Miki Naftali, Chairman and CEO of Naftali Group, talking about the residential real estate business in Manhattan. Abigail, Doolittle, markets reporter for Bloomberg News, also joining us, helping us kind of spend some more time on the real estate business. I find it fascinating, and there's a lot of different pockets I'm learning. Some are doing better than others.
I was going to say, are you interested in luxury apartment buying in the city?
No, Jersey. Those days are over. Those days are over. I sold everything I owned, and now safely ensconced down to Jersey.
Yeah,
so
that's definitely something.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.